JP Morgan CEO Jamie Dimon issued a warning on the earnings call Tuesday. He said, quote, "I probably shouldn't say this." Okay, but of course Jamie said it, because that's Jamie. "But when you see one cockroach, there are probably more." Dimon was referring to the bankruptcies recently of the auto dealer Tricolor Holdings and auto parts conglomerate First Brands Group. But there has been clapback about that. RBC Capital Markets Managing Director and head large cap U.S. bank analyst Gerard Cassidy is here. And when we talk about the clapback, Gerard, it was private credit lender Blue Owl. And the CEO, co-CEO Mark Lipschultz today had a message for Jamie Dimon when he spoke at the CAIS investment conference in California. And he was like, well, we're not seeing a rise in defaults. We're not seeing companies struggling. It's the big banks who might want to look at their own books for any cockroaches. So who's right on this one? Is it a credit quality problem? Are you seeing any signs of that?
Liz, we're not seeing any signs. And even though the banks, Jamie Dimon specifically yesterday pointed out the problems in that one particular credit, that credit is alleged a fraud, as is the large automobile parts manufacturer, First Brand. There's allegations of maybe, a fraud there as well. So we believe at this point those are idiosyncratic. But to Jamie Dimon's point, when there's a credit debacle and the trends really deteriorate, I'm with him on the cockroach theory. But these two, I don't believe, lead to a cockroach theory just yet.
I guess Jamie would argue, and I don't want to put words in his mouth, but that there has been a lot of lending off the big banks' books, and it has been done by the private credit guys. And those are the ones that these companies, most companies, go to these days to get loans. Granted, they pay a higher interest rate, but they get them and they don't have to deal with all of the, I guess, paperwork in certain cases and publicity about it. So my question really is, we can't really see all of that happening. Are you worried at all that, as Warren Buffett says, when the tide does go out, you see who's swimming naked?
We are very worried about it, Liz. And the reason being is when you go through the past credit cycles, what you need prior to the credit cycle is a period of rapid loan growth. And we have certainly seen that in private credit. So certainly we're not seeing any evidence today of real problems. But in the next credit cycle, which is normally joined with an economic recession, we are going to see credit deterioration in private credit as well as the banks. And that's when, to your point about Warren Buffett, what he said, that's when we're going to find out who really has the problems. Now, private credit isn't as levered as the banks are. So there's that differential. But I would say, as you pointed out again, that they're lending at higher rates of interest. And part of the reason is those credits are riskier. The banks are regulated, private credit is not, and therefore the banks have to be more conservative in their lending.
All right. There are investors here who are still ready, no matter what, to put money to work. Where do you see the opportunity, Gerard?
We anticipate, Liz, that if the Fed cuts another 50 basis points at the short end of the curve over the next 3 to 6 months, the yield curve will steepen. And we'll have a Fed funds rate around 3.25 to 3.5, and possibly a 10-year over 4%. It's been 20 years since the banks have experienced an environment where the Fed funds rate's been over 3 with a positive yield curve of over 75 basis points. That is a very lucrative market for lending. Therefore, the regional banks should do better because more of their revenues come from lending. Banks like Fifth Third, KeyCorp, are good examples of investors looking, for investors looking to make that play. Bank of America is another one. They pointed out today they see possibly 6% growth in net interest income next year, which for a large bank like that is quite powerful.
So KeyCorp, as you mentioned, okay, they're down today. KeyCorp's down about 2%. But as you look at those names, they are the larger regionals. Is there something better about those versus the smaller cap ones?
The smaller cap ones are certainly something investors can look to. And years ago, Liz, they were often considered to be great acquisition targets. But because of the change in accounting 20 years ago, acquisition premiums are not as substantial as they used to be. So it's tougher to make an investment case to make money owning a basket of takeover targets, if you will. So sticking with the larger regionals, we think, is the way to go. And there's also some smaller regionals. They tend to focus more on commercial real estate lending, which, as you know, is not a real problem for the smaller banks because they don't do the downtown office properties, which has been a problem.
Yes.
But what's interesting is the big regionals have the C&I lending, commercial lending.
Consolidation in the regionals. Are you seeing any of that? Do you expect to see more of that? There's thousands of them.
Oh, there sure are. And when you take a look at them today, we have about 4,300 banks in America. That's down from about 18,000 in the early 80s. So consolidation has been a way of life for the banking industry. We had a big deal announced not too long ago. Fifth Third is buying Comerica. We expect to see more consolidation, and we expect to see it amongst the bigger regionals, but also amongst the smaller regionals. And Liz, part of the reason is that this new regulatory environment is very supportive of consolidation, and it has expedited the approval process, which has made it more lucrative or more efficient for the banks to acquire one another.
Gotcha. Gerard, thank you. It's been a busy couple of days with these earnings, but we'll continue to watch it. Thank you so much.